All right, welcome back to Finance with Frittles. In our last video, we talked about the time value of money and how we kind of take cash flows in the future and discount them backwards in time to find a present value, or take cash flows in the past and compound them forward to find a future value. But while it's really important to understand the mathematical concepts and premises behind some of these valuations, it's really just as important to be able to understand the practical application and how we can use them in everyday life. So this video is all about understanding through practical application to give you a little bit of a piece of just exactly where we'd apply and utilize some of this information in a real life situation. Today, it's the practical application of the time value of money on Finance with Frittles.
Alright, so our first practical application assumes that it's tax season now, and we're going to go ahead and look at investing some of our tax return both this year and next year in order to generate a little bit of a return. So what we're going to do is we're going to invest $1,000 now, and then we're going to invest $1,000 a year from now with our tax return that we get next year. Now we need to determine what our interest rate is, or what we can expect to return on our invested capital. And our ultimate question is, what is the future value 2 years from now? In other words, how much are we going to have in that account if we were to invest both this year and next year $1,000 from our tax returns? Well, the first step is finding this interest rate right here so we can know at which rate we grow our cash flows over time. And our first step is to look at which type of fund we'd like to invest in. So we're just going to shoot for a regular S&P 500 index fund, just a large cap US equity fund. And we're going to use this 500 index Admiral shares from Vanguard's website as a kind of a proxy, if you will. Or this might be the actual fund in which we invest. But if you click on price and performance there, you can kind of see exactly how it's done over the last year, 3 years, 5 years, 10 years, and since inception. You notice here the since inception figure, it's fairly low because it started right there at the end of 2000. And got hammered in both the dot-com bust there, or the tech wreck, or whatever you want to call it, in the early 2000s, as well as the '08 subprime mortgage crisis. So they're two massive hits to domestic equities there that kind of lower that figure. But over the past 10 years, you can see a figure right there, 14%, 11.3 for the 5-year, about 13.3 for the 3-year, and almost 8% for the 1-year. So we'll be a little conservative here, and we'll use these figures. And again, you don't know for sure, but we're going to presuppose that I guess this fund might increase at a value of about 8% per year over the next couple of years. So let's go ahead and look here. As we type in 8%, that's going to be our value that we utilize for our expected growth. So it's best to start off here with a timeline so we can kind of visualize what we're looking at here. So we'll have this starting point be year 0, and then we'll have 1 a year down the road, and then year 2 thereafter. And according to our problem, we have $1,000 that we're going to invest here in year 0, and then another $1,000 that we're going to invest in year 1 when we get our tax return next year. And that's important to kind of not get these confused, is that year 0 is the one right away. That's the first cash flow. So you'll notice here that we have this first cash flow here. That's year 0, which is the first cash flow, and year 1 is the second cash flow. Just a little bit of terminology that we don't want to get confused on, but understand exactly what's going on there. So in order to look at this, we use the same equation. The future value that we know is equal to the present value times 1 plus the interest rate. That's the expected rate of return we'll receive on this investment to the n, or the number of years that we're going to be compounding those cash flows forward. Well, you see the first cash flow here, it needs to compound forward not just 1 but 2 years in order to get to our 2-year point where we're going to observe just exactly the value in our account. And the second cash flow, it'll need to compound forward just 1 year. So that'll be important in our calculations. But let's go ahead and take a look at this. So let's call this cash flow 1 here and cash flow 2 here. We'll write out our calculations down here for cash flow 1 and cash flow 2. So for cash flow 1, we start off by saying that the future value in year 2 is going to be equal to the present value in year 0 times 1 plus the interest rate. That's the 8% that we have. So we'll go ahead and write that up here. We're going to say 8% is what we're expecting to return to the n. And this n is the number of years or number of periods. So we're going to utilize 2 here, raise it to the second power because we're compounding forward 2 years in time. So the present value, that's $1,000. That's what we put in. We multiply it by 1.08, or 1 plus 8% squared. And if we run that calculation, we come out with a figure of $1,166.40. So that's a good little return there. As for the second one, the second cash flow, we know that the future value in year 2 is equal to its present value in year 1 times 1 plus the interest rate to the first. Why? Because we're only compounding forward 1 year in time. So that's the same thing as $1,000 times 1.08, or 1 plus the interest rate of 8%, to the first. And if you run that calculation, you come out with a value of $1,080. So we got $1,080 from our first cash flow, and we got $1166.40. $1,080 from our second cash flow, and $1166.40 from our first cash flow. So the total value in our account, that's the total future value, is going to be equal to the two future values summed together. So future value of the first cash flow plus the future value of the second cash flow. So put 1 CF down here to denote that one, and 2 CF down here to denote that one. So the future value of the first cash flow, that's just $1166.40. And we add that to $1,080, and we come up with a value of $2,246.40. So we can see here we input $2,000, and we grew our account by $246.40. So our gain, or our total return of both capital appreciation and dividends, is equal to $246.40. So that's pretty interesting there, good little return. If we wanted to just see exactly how much we returned over those 2 years, we'd recognize that we have $246.40 divided into our original commitment of $2,000, and that comes out to a value of 12.3%. So over the 2 years, we returned a total of 12.3% of what we had invested, resulting in a future value in our account of $2,246.40. Alrighty, back to finance for our second example here. Let's say you have an associate. He calls you up, says, hey, look, I work at a venture capital company. We've got a good investment opportunity. I'm coming to you for money. And you actually have some money. You have $100,000. And he says, if you invest $100,000 today, I'll use the proceeds from the company to give you $45,000 in a year, and I'll give you $70,000 in 2 years. And you say, okay, that seems pretty interesting. I know that $45,000 and $70,000 combined together is $115,000. So I would definitely be making money on this investment, but I want you to tell me about the company. And so the colleague tells you about this company, and you recognize when he's done that it's a fairly risky company. So you have a required rate of return of 14%, fairly high, in order to reflect the risk in that company. And the ultimate question is, should you invest in this opportunity? So it's always best to analyze these opportunities by starting off with a nice timeline. We can get a good picture here of just exactly what's going on. So we have year 0, we know we have a cash flow coming in year 1, and we know we have a cash flow coming in year 2. Now that first year cash flow, that's negative $100,000 because we have to give up or pay or invest $100,000 right out of the bat. But then we receive a positive cash flow of $45,000 in year 1. That's the second cash flow. Our third cash flow is a $70,000 cash flow that comes in year 2. And remember, we had an interest rate or a required rate of return that was equal to 14%. So when it comes to analyzing these cash flows, we want to take each one of the cash flows and sum them all together in the present value context to find out exactly what they're worth. So we're going to take this first cash flow here, we're going to discount it backwards in time 1 year, and we're going to take the second cash flow and we're going to discount it backwards in time 2 years, and then we're going to sum all 3 of these cash flows together in their present value form to figure out whether it's worth the initial $100,000 that we give up. So when it comes to the actual calculations, we're going to need to find a present value of cash flow 1, of cash flow 2, and of cash flow 3. So when we analyze this, we can simply start with the first one. Let's start with the negative $100,000. You can see this guy right here, it starts out in year 0, so it doesn't have to be compounded forward. It doesn't have to be discounted backwards in time. It stays at a value of negative $100,000. Now for the second cash flow, we use the equation that states that the present value of a cash flow is equal to the future value of that cash flow divided by 1 plus the interest rate or required rate of return to the n. Now our n in this case for the first cash flow, that's just 1 year here. The second cash flow will have an n of 2 years because it's being discounted backwards in time 2 years. So to run that calculation, we simply say the future value, that's $45,000, divided by 1 plus I, that's 1 plus 0.14 or 14% in decimal form, to the first power will give us that 1 year discounted rate. And when we run the calculation, we get a value of $39,473, and there's some change on there, 68 cents. All right, so we've got the present value of the first cash flow. correction, we have the present value of the year one cash flow, which is technically the second. All right, for the third cash flow in year two, we're going to look at this and we say we have a future value of $70,000 coming in. $70,000. So if we divide that by 1 plus 0.14, that's the same interest rate, to the second, we can find out what our present value is. And if we run the calculation, we come up with a value of $53,862.73. Okay, so a good little boost there. We notice that this $70,000, it really came down in value, down to $53,000. We only had a drop from 45 to 39 on the first cash flow, but a more significant drop from 70,000 up here down to 53,000 down here. And that's just because we're discounting backwards in time more and more. If you were to have cash flows in year 3 and cash flows in year 4 and so on and so forth, you would notice that they would drop more and more and more and more. A larger and larger proportion or percentage of their value would be eroded as you discount in time. And that's just the nature of the fact that you have cash flows in the future. Well, if they're further in the future, they're a little bit more risky. So finally, we want to look at our net present value and compare that to our original $100,000 that we gave up. So the net present value is just the sum of the three cash flows. Now the sum of those three cash flows is the sum of negative $100,000, $39,473, and $53,862. So it's just the sum of cash flow 1, cash flow 2, and cash flow 3. So if we run that simple calculation, we find that the net present value of those three cash flows is $93,336 and some change, 41 cents. Okay, so we have a $93,000 or thereabouts present value, but we had to give up $100,000 up here. So our net present value is less than the original cash flow that we had to expend. In other words, there's no way we're going to give up $100,000 right away when the actual worth of all of these cash flows or value of all these cash flows is only $93,000. So the answer is no, we would not invest in this opportunity.